Brought to you by Qatar Airways, world's 5-star airline.
Welcome back. This is Your World at 10. Now, with all eyes on Europe's sovereign debt problem, we thought it pertinent to get you the view of an institution that has been working hard to resolve some of Greece's problems. The Institute of International Finance, or the IIF, has been negotiating with Greece's private lenders on the bond swap, which is an important element of the second bailout that the Troika handed to Greece. Joining me tonight from Washington is TRAN. He's the Deputy Managing Director at the IIF and the Director of Capital Markets at the IIF. Mr. TRAN, thank you very much for your time. Let me start by asking you about the success of this bond swap. The last we read, based on news reports, was that only 75% of the private bondholders or lenders to Greece had in fact agreed to that bond swap, whereas Greece had set the minimum acceptance level at 90%, which leads me to believe that the bond swap might fail. And if the bond swap fails, does it put the second bailout at peril?
I think that it is important to realize that there hasn't been any formal offer being extended by Greece to private sector holders of its government bonds, and therefore there cannot be any acceptance of something which is not having been formally offered. There have been a range of informal information meetings that have been held with private sector investors to exchange information, to explain the different options in the exchange program. And judging by attendance at those meetings and the questions raised, we see a lot of interest on the part of investors. Also, from our contacts with our membership, the level of interest is high. And also, last but not least, looking at market developments in recent weeks, I think that participation in the exchange will be very high in my view. How
imminent is the threat of a potential default by Greece? And the reason I ask you this question, even though it's been a question that we've been asking since the beginning of the year, is that it seems Europe has done everything it can to kick the can further down the road. With the kind of new austerity measures that are being heaped upon Greece, it seems more and more unlikely that Greece will be able to meet them, and therefore the specter of a default seems to be growing. In your assessment, how likely is it?
I think that three key points I wish to make. One is that despite all the noises in the marketplace, Greece is still able to refund itself in the short-term treasury bill markets. Today, Greece successfully auctioned what they intend to do, 1.25 billion euro, ended up with 1.625 billion euro of 3-month bills at a slightly higher interest rate than at the same auction last month, with 2.85 bid to cover ratio. And therefore, to that extent, if Greece is able to do that, that is one positive. Second, the question is really whether or not the European authorities, the EU and the IMF, will be able to sign off on Greece's new effort to bridge the gap of deficit targets for this year. And therefore, we have the second part of the conference call going on later today in Europe. And I believe that the European authorities will go ahead and make the sixth disbursement to Greece in due time. And therefore, the question of default, given that these two things have already likely to happen, in my view, is very unlikely. The more important question is, are we just kicking the can down the road, and will Greece ever get out of this predicament? I believe that if the July 21st package of support to Greece, composing of official financing support for Greece, sustained effort and progress by the Greek government and people to implement reform, and the private sector voluntary contribution in the form of the debt exchange and debt buyback, if all three of these components are implemented in full and on time, I think that Greece will have the next 9 years being relieved of any need to come up with a significant volume of money every year to retire or to meet the redemption payment for maturing bonds, and therefore will be able in a position to focus more on doing its homework to do the reform, and at the end of that period will be able very much before the end of that period will be able to tap international capital markets and will be able to grow. So I think that it is very important that the July 21st agreement as announced in Brussels should be implemented as quickly as possible.
Mr. Tran, you've struck a very positive note, but considering that, there has been haggling and negotiation even on the sixth tranche of the first bailout, the chances of the July 21st package, which essentially, if I understand correctly, is the second bailout, going through are very, very low at this point in time, especially given the political background in Europe, given the kind of defeats Angela Merkel has suffered in Germany in recent regional elections. But I won't dwell on that point any further because I'm sure you're equally familiar with it. What I'd really like for you to share with me is your assessment of the kind of stress you see because of the sovereign debt burden on non-Greek European banks. We have seen considerable volatility and nervousness with regards to French banks in the recent past. Can you put a number to the kind of burden of sovereign debt or sovereign bonds that they're carrying of, let's say, Greece, and really how you expect this to pan out over the next few months if the uncertainty surrounding Greece continues?
Yes, indeed, one of the issues that European banks have to deal with in recent period is the fact that they are highly exposed to government bonds, including those of their own countries. Take one example of the 90 banks in Europe that have undergone the stress test by the European Banking Authority. They collectively have about 3 trillion euro of government bonds, including those of their own countries, and that is about 8% of their assets. By comparison, U.S. banks have about $165 billion of U.S. treasuries, or about 1.2% of their assets. And therefore, to the extent that many of the government bonds held by non-Greek European banks are now under stress in the sense of having perceived unsustainability of their deficit and debt level, and therefore the credit quality of some of those bonds are being reduced. There's a question about the potential losses that the banks will have to be exposed to. Therefore, I think it is clear that for many European banks, for some banks in some countries, there's a clear need that they need to move as quickly as they can to beef up their capital, looking at market sources. The announced merger of 2 banks in Greece last month with some additional participation from private sector investor is something that is a very welcome development. But overall, you are right in the sense that banks in Europe are having to cope with this challenge at the moment.
Mr. Tran, I'm going to ask you a final question, and it's many questions rolled into one. You have agreed that yes, there is considerable pressure on financial institutions outside of Greece as well. If you can tell me where they're going to raise this money from, because the market right now doesn't seem to be very conducive to several of these French banks being able to go out there and raise money. The ECB is spending so much money on helping or intervening in the bond market for Spain and Italy, and considering its own capital, it too is going to be stretched in a sense. We don't have any consensus on the expansion of the ESFS, so I'm curious to know where you think that additional capitalization is going to come in for banks, and at what kind of role you see the ECB playing in the coming months to help stem the nervousness in this market.
I think that the ECB has done a very commendable job in terms of acting as a lender of last resort when there is a liquidity problem time and again during the 2008-2009 crisis, and more recently over the course of the past few weeks and months. And I think that to that extent, acting as lender of last resort the ECB would have plenty of resources to make sure that banks, if they have a liquidity problem, should be able to meet with those problems. In terms of capitalization, I mentioned that the July 21st agreement should be implemented as promptly as possible, because one of the provisions that European leaders agree in Brussels is to authorize the EFSF, the European Financial Stability Facility, to be able to make contribution or to invest in the recapitalization of banks if there should be the need for those. So I think those are the vehicles and the institutions that need to be put in place as promptly as possible.
Mr. Tran, I appreciate you finding the time to come speak with us and share your perspective. If only politicians were able to get together and back what you have just pointed out. That's Hung Tran of the IIF speaking to us about the situation in Greece and across Europe. With that, I'm going to wrap up this edition of Your World at 10. Thanks very much for watching. Keep